Picture this. You wake up one morning, grab your phone, and see headlines screaming market crash. Stocks are plummeting. Panic is everywhere. But instead of your heart sinking, you feel calm, confident, even. Imagine knowing with total certainty that your financial future is secure, poised to grow no matter what economic storms are brewing. This isn't a fantasy. It's what it means to be unshakable. For most, this feels like an impossible dream. But today, we're unlocking the secrets from Tony Robbins' masterpiece, Unshakeable, a playbook designed to build a financial fortress. And the best part, it's for everyone, even if you're just starting out. Here at Wealthnetic, we're learners, who's like you. We dive into these powerful ideas, break them down, and share the journey. So, if you've ever felt like the stock market is a roller coaster you can't control, you're in the right place. We're about to explore the core principles that empower ordinary people to become extraordinary investors, protecting and growing their wealth in any climate. Let's get started. So, who is Tony Robbins, and why should we listen to him about money? Many know him as the world's #1 life and business strategist, a high-energy guru who helps people break through their personal limitations. But what some don't realize is that he's also spent decades gaining access to the greatest financial minds on the planet. People like Ray Dalio, Warren Buffett, and Carl Icahn. He interviewed over 50 of TSE's self-made billionaires for his previous book, Money, Master the Game. Unshakeable is the condensed, simplified playbook that followed. It was written for one purpose: to take the complex world of investing and make it accessible for the average person. It's not about get-rich-quick schemes. It's about applying proven, timeless principles to build lasting wealth and achieve true financial peace. In a world full of noise and fear, this book serves as a clear, rational guide to navigating the markets and securing your freedom. Let's dive into the core principles. The first, and perhaps most important, is understanding the truth about market crashes. We're taught to fear them. But Robbins, echoing the greatest investors, reveals that corrections and crashes are a normal, recurring part of the economic cycle. They're not the exception, they're the rule. Since 1900, the market has experienced a correction, a drop of 10% or more, roughly once a year on average. A bear market, a drop of 20% or more, happens about every 3 to 5 years. The key insight: every single bear market in U.S. history has been followed by a bull market recovery and a new all-time high. Every single one. So, what does this mean for you? It means that market downturns aren't a reason to panic and sell. They are the single greatest opportunity to buy. Think of it as a sale. When your favorite store has a 30% off sale, do you run away screaming? No. You rush in to buy. The stock market is the only place where people run out of the store when things go on sale. The unshakable investor understands this. They see crashes not as a threat, but as a fire sale on quality assets, a chance to accelerate their wealth-building journey. Now that we've reframed our fear of crashes, how do we build a portfolio that can withstand them? This brings us to Principle 2, asset allocation. Tony calls this the single most important investment decision you will ever make. It's not about picking the perfect stock. It's about deciding how you divide your money across different categories of assets or asset classes. Think of it like building a house. You need a strong foundation. In investing, your asset allocation is that foundation. The main asset classes are stocks, which represent ownership and growth, and bonds, which are like loans that provide stability and income. You also have alternatives like real estate and commodities. The goal is to create a mix that aligns with your personal risk tolerance and financial goals. A younger person might have more in stocks for a long-term growth, while someone nearing retirement might have more in bonds for preservation and income. The key isn't finding one magic formula. It's about creating a diversified blend so that when one part of your portfolio is down, another part is likely to be up, smoothing out your ride and protecting you from catastrophic losses. Building on that foundation, we have Principle 3, diversification and rebalancing. This is your shield. Diversification isn't just about owning a bunch of different stocks. True diversification means spreading your investments across different asset classes, as we just discussed, but also within those classes. So, You wouldn't just own tech stocks. You'd own stocks and healthcare, finance, and consumer goods. You'd own stocks in the US and internationally. This prevents a problem in one company or one sector from wrecking your entire portfolio. But diversification has a partner: rebalancing. Let's say your target allocation is 60% stocks and 40% bonds. After a great year for stocks, your portfolio might drift to 70% stocks and 30% bonds. It's now riskier than you intended. Rebalancing is the simple discipline of periodically selling some of your winners in this case. Stocks and buying more of your underperformers, bonds to return to your original target. This forces you to do what every great investor does: buy low and sell high. It's an automatic, emotion-free strategy that locks in gains and reduces risk, keeping your financial fortress strong and stable. Next up is Principle 4, harnessing the twin engines of wealth: growth, compounding, and automation. Albert Einstein supposedly called compound interest the eighth wonder of the world. It's the process where your earnings start generating their own earnings. It's a snowball effect. At first, it's slow, almost unnoticeable. But over time, it becomes an unstoppable force, creating exponential growth. The single most important ingredient for compounding is time. The earlier you start, the more powerful it becomes. A 20-year-old who invests just a few $100s a month can easily end up with more than a 30-year-old who invests double that amount, simply because their money had an extra decade to work its magic. So how do we make sure this happens? Through automation. Don't rely on willpower. Set up automatic contributions from your paycheck into your investment accounts every single month. By making it automatic, you remove emotion from the equation. You invest consistently, whether the market is up or down, a strategy called dollar cost averaging. This simple act of automating your savings and investments is probably the most powerful step you can take toward becoming unshakable. Finally, none of these strategies matter if you cool and control the person staring back at you in the mirror. This is where we must overcome our own behavioral biases. Our brains are hardwired for survival, not for modern investing. We're driven by fear and greed. We feel the pain of a loss twice as much as the pleasure of an equivalent gain, which makes us sell at the worst possible time, the bottom. We chase hot trends, buying high out of a fear of missing out, only to see them crash. We think we're smarter than the market, trying to time it perfectly, when history shows that even the pros fail at this consistently. The unshakable investor acknowledges these biases. They create a plan based on the principles we've discussed: a solid asset allocation, diversification, and automation. And they stick to it. They mastered their mind before they try to master their money. They know that the biggest threat to their financial future isn't a market crash. It's their own emotional reactions. By creating a rules-based system, you take your worst enemy, yourself, out of the equation. So, let's bring it all together. Becoming an unshakable investor isn't about being a genius or having a crystal ball. It's about understanding a few core truths and acting on them with discipline. First, market crashes are not the end of the world. They are opportunities in disguise. Second, your asset allocation is the foundation of your entire financial house. Third, diversification and rebalancing are your shield and your disciplined strategy for buying low and selling high. And finally, you unleash the magic of compounding through the simple, powerful act of automation, all while keeping your own emotional biases in check. The path to financial peace isn't complex, but it does require you to take action. Start by figuring out your goals, creating a simple plan, and automating it. Don't let fear dictate your destiny. You have the power to build a secure and abundant financial future, to become truly unshakable. Thank you so much for joining us on this journey through Tony Robbins, Unshakeable. I hope you found it as empowering as we did. What's the biggest investing fear you're working to overcome? Let us know in the comments below. We'd love to hear from you. If you got value from this video, please give it a thumbs up and subscribe to Wealthnetic for more deep dives into the books that shape our financial lives. Thanks for watching, and we'll see you in the next one.